Let's start with what's been going on with oil prices, because we just had the worst two-day slump in 6 months, down by around 10%. And it's interesting how, for some assets, we're talking about negativity around China. You've made this point to me earlier on today, negativity around China, and that seems to be what's weighing on short-term oil prices right now, even though expectations of better times in China can lift other assets, such as European stocks. How do you try and square that?
So there's a bit of superficial confusion here, but I think there's an explanation. So one is that, Chinese assets and greater China assets, whether Hong Kong, anywhere in the region, have been just surging in the last month on China reopening optimism. And it's part of the European story at the start of this year. You mentioned how well European stocks done at the start of this year, and part of the China reoptimism. So why are oil prices trading a more negative story? Well, that seems confusing, but part of it is oil prices do trade off physical delivery, and therefore they can't look quite as far into the future, and therefore they're a little bit more sensitive to the current situation. And the current situation is uncertain, even if we're very, very optimistic on the long-term trajectory. So I think that's one part of it. Although I do think that oil prices have one other aspect of negativity, which is that we had that incredibly poor weather before Christmas in America that's kind of disrupted the situation. And then we also then had the very warm weather in Europe, which meant we kind of dismissed the energy crisis in the short term from Europe, and energy crisis across the board fell. So there's been a lot of distortion in oil markets, and I think that ultimately we're going to get through that, and I think oil prices will catch a bid again soon.
OK, so it's a difference in terms of the way that the oil market trades, and I know it's in contango, and so we are seeing the China story, as you point out, weighing on short-term expectations, even if maybe there are more medium-term expectations of growth there when China does recover. Let me ask you about the inflation story and where we've got to there in Europe, because if lower yields and perhaps at the margin, some people dialing back their expectations of ECB rate hikes, is that something that has been supporting Europe? There have been a lot of things, as you've suggested, supporting Europe. There's that story and the China narrative.
Yeah, I think they're the two big aspects, the energy prices coming down and the China optimism. It's just been wonderful for Europe. Therefore, we've got these really low inflation prints. We've got rid of the big tail risk of the energy crisis, and therefore European stocks that I don't think it's a good economic story for Europe, but they were already very discounted. So they've got a bit of a surge into the new year, and it makes sense. Can it continue? I'm a little bit nervous. I wouldn't be necessarily particularly optimistic about Europe, but they have been so beaten down. I'm not very, very negative. I do think that, energy prices were not through the structural energy crisis, and therefore they're unlikely to fall much further in the short term. So I think we can get a little bit of a bid there, and I think the ECB likewise won't read too much into the fact that these lower short-term inflation prints this week, because they're going to say that's because the volatile energy, it's going to be volatile other components. Yeah. The sticky core components are still very, very strong, and ECB will still want to hike rates.
And I know that our colleague Ven Ram was saying yesterday, actually, these inflation prints aren't all that far away from what the ECB was expecting itself anyway. Let me ask you about the Fed. We had the minutes. Didn't seem to impact markets an enormous amount, or not as much as it has done sometimes. Are you at all worried that the market continues to price in rate cuts that the Fed says it's not going to deliver?
I'm not too worried because later on this year, I am still in the camp that the Fed are unlikely to cut rates this year, or if it happens, it might be towards the very end of the year. I think that they will maintain a higher policy rate than the market currently expects, and that is still my base case. I'll remain flexible about that, but I don't think the alignment's too wrong. It's already made the kind of adjustment, and therefore I do think the next move in yields is likely to be higher from here.
OK, thanks very much to Mark for thoughts so far. Remember, you can get up-to-date analysis and insight from Mark and the rest of the Markets Live team. MLI Vigo is the function to use on the Bloomberg terminal.